Hey everybody, Chris Mattis with Inform Mortgage. I recently posted about mortgage junk mail and the onslaught of solicitations we get at the mailbox every week. This was actually in response to a client who called asking if a mortgage letter she received was true and legitimate. She was confused. She was looking for guidance. So I just wanted to take a bit of a deeper dive, run through this letter, talk about where the information comes from, what to look out for when you receive them, and how to tell if they're really legitimate or not. Right. So the first thing to realize and remember is that all of the information that the lenders use in these letters comes from public record. They know who you are, where you live, how much money you borrowed, and who you borrowed it from. And they're always going to make the letter appear as if it came from your current lender, because it's going to increase the chances that you'll call in and talk to them. And that's ultimately what they're trying to do, get you on the phone to try to solicit you for a loan. So in this case, the borrower's current mortgage servicer is PennyMac. She was confused. She didn't know if it was legitimate or not, or if she should call. So she called me instead, which is the right thing to do. Always call someone you trust in the business. Your mortgage professional can guide you. But the other thing to note here is if we look at the payment information, this is what really caught her eye. She pays $2,700 a month for her FHA mortgage. So this letter is telling her that she can potentially lower that to $1,995. That's a massive reduction, over $700 a month, right? Who wouldn't want to save $700 a month? But what the letter fails to point out, and what she didn't realize, was that this is principal and interest only. It doesn't include her taxes and insurance, right? So at the end of the day, when we calculate the monthly savings, it's way lower. The other thing is you can look a little deeper into the fine print to see how they're coming up with that number to begin with. So this will tell you that the payments are based on a 30-year fixed rate at 5.75% and using the original loan amount of her loan about a year ago when she bought the house of $341,880. That's all well and good, but it leaves out two glaring omissions. First, this is an FHA loan. So if it was refinanced, another 1.75% in mortgage insurance premium will be added on top of the loan amount. And two, it just completely ignores the closing costs altogether. And three, it doesn't make any mention of what that interest rate actually costs in discount points. So today, mortgage rates on FHA loans are about 6.5%. That's what we would call best execution, where most people would close without paying an arm and a leg in points and fees. Could you get 5.75? Absolutely. It's available. It just costs a lot of money. So we ran the numbers for her, and the closing costs on this transaction, if she were to move forward with it, would have exceeded $23,000. The monthly savings, if she paid that in cash, would have been about $166 a month, which is very steep for $166 savings. But if she financed the $23,000 into the mortgage, which pretty much everybody does when they refinance, that monthly savings would have dropped to under $88 a month, right? So much smaller savings when you increase the loan amount and you factor in the closing costs. So she was very excited for a minute, but also very grateful that we took the time to go through this with her and explain it to her. So guys, just be really careful and weary of anything that sounds too good to be true. If it sounds that way, it probably is. So don't fall for the tricks and the deception. Throw the junk mail in the trash and make an informed financial decision. I'm Chris Mattis, and until next time, it's good to be informed.